Ladies and gentlemen, let me ask you a question. What happens when the most powerful institutions in the financial world blink first? When the noise fades, the charts go quiet, and suddenly one number changes everything. Today, that number is $92, and make no mistake, this isn't just a price. This is a signal. This is the moment the war ended. The decision by major banking institutions to scale back or fully exit positions at the $92 level reflected a deliberate shift in strategy rather than a reactionary move driven by short-term price fluctuations. For an extended period, banks maintained exposure despite mounting volatility, supported by internal forecasts that assumed liquidity would remain stable and downside risk manageable. However, as price action repeatedly tested the $92 zone, internal indicators began flashing warnings. Volatility thresholds were breached, hedging costs increased, and balance sheet efficiency declined. What looked sustainable on paper was no longer sustainable in practice. Here's the first hook that cannot be ignored. Banks tolerate uncertainty, but they do not tolerate unpredictability. At $92, market behavior became increasingly asymmetric, meaning downside risk accelerated faster than upside potential. Stress scenarios that once appeared remote move closer to baseline assumptions. When this shift occurs, institutional playbooks demand action. Continuing to hold positions would have exposed banks to compounding losses under even minor adverse moves, a risk profile that no risk committee can justify. The exit at this level also reflected mounting internal pressures beyond pure price movement. Regulatory capital requirements tightened as volatility rose, forcing institutions to allocate more capital to support existing positions. At the same time, funding markets began to price in higher risk premiums, increasing the cost of leverage. This created a squeeze where maintaining exposure became progressively more expensive. The hook here is simple but powerful. When capital efficiency breaks down, scale becomes a liability, not an advantage. What made this moment particularly significant was the consistency of behavior across institutions. Independent desks, operating under different mandates and models, reached similar conclusions within a narrow time frame. That convergence points to a shared recognition that the market environment had shifted materially. Banks were no longer shaping the market, they were responding to it. And when institutions built to manage and distribute, risks begin reacting instead of directing. The power dynamic changes. Another critical hook lies in the nature of the exit itself. Positions were unwound methodically rather than through forced liquidation, indicating anticipation rather than panic. This suggests banks recognized that defending the $92 level would invite further pressure from market participants, testing liquidity and resolve, and by stepping aside early, institutions preserved optionality and avoided becoming trapped in an increasingly fragile structure. Perhaps the most revealing aspect of this move is what it communicates implicitly. Exiting at $92 was an acknowledgement that traditional assumptions, liquidity support, predictable flows, and controllable volatility were no longer reliable. It signaled a recalibration of acceptable risk under new conditions. In that sense, the exit was not just about reducing exposure, it was about conceding that the market had entered a phase where restraint was the most rational form of control. To Bruce, the shift in market power became unmistakable as price action around $92 demonstrated that traditional institutional influence was no longer dictating direction. For years, banks have acted as stabilizers and, at times, silencers of volatility, using size, liquidity access, and coordinated positioning to guide markets within predictable ranges. That influence depends on one assumption. The capital concentration can override collective market behavior. At $92, that assumption failed. The market did not respond to institutional pressure the way it once did, and that alone marks a structural change. Here's the first hook that matters. Power in financial markets is only real when it produces obedience, when prices ignore size, when momentum resists intervention, and when liquidity refuses to bend. Authority dissolves. Around the $92 level, repeated attempts to anchor pricing were met with sustained counterpressure. Instead of stabilizing, the market absorbed institutional activity and continued moving independently. That is not noise. That is a signal. This moment confirmed that influence had become fragmented. Capital was still large, but conviction was no longer unified. Banks found themselves competing not just with other institutions, but with decentralized flows, algorithmic momentum, and increasingly synchronized market participants. When influence disperses, no single entity can dictate outcomes. The hook here is subtle but critical. When control must be negotiated instead of imposed, it is already weakening. Another layer of this shift lies in market psychology. Historically, institutional presence alone could deter aggressive positioning from other participants. At $92, that deterrent effect vanished. Traders and investors continued to apply pressure, confident that traditional backstops would not hold indefinitely. That confidence does not emerge without evidence. It reflects a growing awareness that institutional balance sheets are constrained by regulation, optics, and capital efficiency, limiting how far power can be extended. What made this shift undeniable was the reaction, not the resistance. Instead of escalating defense, banks adjusted posture. That response confirmed that the leverage once used to enforce stability now carried unacceptable cost. When defending a level becomes riskier than abandoning it, influence has already eroded. This is the hook professionals pay attention to. True power does not retreat, it absorbs pressure. Retreat signals transition. The market's behavior following the shift further reinforced the change in dynamics. Liquidity redistributed rapidly, volatility recalibrated, and price discovery accelerated. These are characteristics of markets operating without a dominant anchor. Banks were no longer the gravity. They were participants navigating the same uncertainty as everyone else. At its core, the power shift confirmed at $92 was not about a single price or event. It was about recognition. Recognition that markets have evolved, that influence is conditional, and that authority now depends less on size and more on adaptability. When institutions adjust instead of command, the balance of power has already moved. The turning point at $92 emerged when risk began to outweigh confidence, forcing banks to confront a reality their models could no longer smooth over. Confidence in financial institutions is built on forecasts, historical behavior, and controlled exposure, but it has limits. As prices hovered and tested this level, volatility no longer behaved as a temporary disturbance. Instead, it became embedded in the structure of the market. Correlations shifted. Protective hedges lost efficiency, and downside scenarios that were once considered extreme started to appear increasingly plausible. This was the moment when confidence stopped being an asset and started becoming a liability. Here is the first hook that defines this shift. Confidence works only when risk is measurable. At $92, risk stopped being neatly quantifiable, price movements became sharper, reactions faster, and liquidity less predictable. Small changes in sentiment produced outsized effects, compressing the margin for error. For banks operating at scale, even minor miscalculations can translate into substantial balance sheet impact. When that margin disappears, confidence alone is no longer a strategy. As uncertainty grew, the cost of maintaining exposure rose steadily, volatility premiums expanded, hedging instruments became more expensive, and capital buffers had to be reinforced. Each additional layer of protection reduced profitability, turning previously acceptable positions into inefficient uses of capital. The hook here is unavoidable when protection costs more than potential return. Confidence collapses under its own weight. No institution can justify staying exposed when every safeguard erodes performance. The psychological dimension of this imbalance was equally significant. Confidence in markets is reinforced by predictability, and predictability was fading. Price behavior around $92 suggested that reactions were no longer linear or rational. Instead of orderly adjustments, markets showed signs of reflexivity, where movement itself created more movement. For banks accustomed to managing risk through structured responses, this environment amplifies vulnerability. Confidence thrives in order, it erodes rapidly in reflexive systems. Internal stress testing reflected this deterioration. Scenarios, once assigned low probability, began moving into central risk bands. Value at risk models expanded sharply, forcing reassessments of acceptable exposure. When models repeatedly indicate that downside risk is accelerating faster than upside opportunity, confidence must give way to restraint. This is the hook professionals recognize instantly. When models and markets align in warning, hesitation becomes dangerous. What ultimately tipped the balance was the realization that confidence was no longer being rewarded. Holding positions did not stabilize the market or deter pressure. It increased exposure to adverse momentum. In that environment, reducing risk was not an admission of error, but an acknowledgement of changed conditions. At $92, the equation was clear. Risk had taken the lead, and confidence, no matter how deeply rooted, could no longer justify standing firm. The increase in liquidity flow and the rapid unwinding of positions around the $92 level revealed a deeper layer of pressure operating beneath the surface of the market. Liquidity, often viewed as a sign of health, can also signal urgency when it appears suddenly and in size. As banks began adjusting exposure, bid-ask spreads fluctuated, volume spiked, and transaction velocity increased. This was not routine rebalancing. It was capital moving with intent. The market was being repositioned in real time, and that repositioning carried consequences. Here is the first hook that matters. Liquidity surges are rarely neutral. When large institutions accelerate trades simultaneously, it reflects internal thresholds being breached. Around $92, those thresholds were crossed. Risk limits, funding sensitivities, and stress metrics converged, triggering automated and discretionary responses. Positions that had been built over time were dismantled with precision, not hesitation. That level of coordination points to pressure, not opportunity. As positions were unwound, liquidity redistributed unevenly, certain segments absorbed flow smoothly, while others showed signs of strain. This imbalance exposed how dependent market stability had become on continuous institutional participation. When that participation shifted from providing liquidity to demanding it, the market had to adjust rapidly, and the hook here is critical. When liquidity providers become liquidity takers, volatility is no longer a possibility, it becomes a condition. The mechanics of the unwinding process further highlighted the intensity of internal pressure. Banks prioritized speed and certainty over optimal pricing, accepting slippage in exchange for reduced exposure. That choice alone signals urgency. In stable environments, institutions can afford patience. At $92, patience became expensive. The faster positions were reduced, the lower the risk of being caught in a cascading move, driven by sentiment rather than fundamentals. Another revealing aspect was how derivatives and cash markets interacted during this phase. As positions were unwound, hedges were lifted, rolled, or closed, amplifying volume across related instruments. This created feedback loops, where activity in one market forced adjustments in another. Such loops do not form without stress. They indicate that balance sheets are actively being protected against scenarios that are no longer theoretical. The hook here is unmistakable. When protection mechanisms trigger chain reactions, the system is under pressure. The pace of liquidity movement also reflected heightened sensitivity to perception. Banks understood that prolonged exposure could attract speculative pressure, turning controlled risk into a public test of resilience. By unwinding positions decisively, institutions aimed to limit visibility and reduce the incentive for further challenge. This behavior underscores a critical shift. Liquidity was no longer being used to influence direction, but to exit efficiently. At $92, liquidity and position unwinding became a mirror of institutional reality. Capital was not flowing to assert dominance or stabilize price, it was moving to relieve pressure. In that moment, the market revealed how quickly structure can change when internal safeguards activate and liquidity transforms from a support system into an escape route. But the emergence of $92 as a psychological and historical benchmark was not the result of coincidence, but of repeated market interaction that embedded the level into collective awareness. Price levels become meaningful only when they are tested, defended, and ultimately acknowledged by participants across the spectrum. Around $92, the market paused, reacted, and recalibrated multiple times. Imprinting the number into trading behavior and decision-making frameworks, what began as a technical reference evolved into a mental anchor. Here is the first hook that defines its importance. Markets remember where confidence breaks. The activity clustered around $92 signaled more than resistance or support. It marked a point where expectations shifted. Traders, institutions, and observers began interpreting movement relative to this level as confirmation or rejection of broader narratives. Once a price takes on that role, it stops being just a number and starts influencing behavior before any trade is even placed. The psychological weight of $92 was reinforced by visibility, media attention, market commentary, and internal briefings repeatedly referenced the level, amplifying its significance. This repetition conditioned participants to anticipate reactions near that price, creating self-reinforcing dynamics. The hook here is subtle but powerful. When enough people watch the same level, the level begins to matter regardless of fundamentals. Anticipation itself becomes a market force. At $92, liquidity and position unwinding became a mirror of institutional reality. Capital was not flowing to assert dominance or stabilize price. It was moving to relieve pressure. In that moment, the market revealed how quickly structure can change when internal safeguards activate and liquidity transforms from a support system into an escape route. The emergence of $92 as a psychological and historical benchmark was not the result of coincidence, but of repeated market interaction that embedded the level into collective awareness. Price levels become meaningful only when they are tested, defended, and ultimately acknowledged by participants across the spectrum. Around $92, the market paused, reacted, and recalibrated multiple times, imprinting the number into trading behavior and decision-making frameworks. What began as a technical reference evolved into a mental anchor. Here's the first hook that defines its importance. Markets remember where confidence breaks. The activity clustered around $92 signaled more than resistance or support. It marked a point where expectations shifted. Traders, institutions, and observers began interpreting movement relative to this level as confirmation or rejection of broader narratives. Once a price takes on that role, it stops being just a number and starts influencing behavior before any trade is even placed. The psychological weight of $92 was reinforced by visibility, media attention, market commentary, and internal briefings repeatedly referenced the level, amplifying its significance. This repetition conditioned participants to anticipate reactions near that price, creating self-reinforcing dynamics. The hook here is subtle but powerful. When enough people watch the same level, the level begins to matter, regardless of fundamentals. Anticipation itself becomes a market force. And this shift became evident through subtle but consistent changes in how price responded to information, liquidity, and sentiment. Familiar patterns began to lose reliability, and strategies that once delivered stability produced diminishing returns. This was not a temporary adjustment, it was the early structure of a different environment taking shape. Here is the first hook that frames this transition. New phases are recognized when old rules stop working. Around $92, interventions failed to generate lasting direction, and volatility no longer resolved into predictable ranges. Price discovery accelerated, reflecting a market no longer anchored by dominant participants. When reactions replace control, a phase change is already underway. Transparency became a defining characteristic of this new environment. Movements that were once smoothed by institutional buffering became visible, exposing genuine supply and demand dynamics. This clarity altered decision-making across the market. Participants could no longer rely on assumed backstops or delayed reactions. The hook here is direct. When markets show their true shape, hesitation is punished, and adaptability is rewarded. Investor and trader behavior also evolved. Instead of positioning based on expectations of institutional defense, participants responded more directly to momentum and data. This shift reduced the effectiveness of traditional deterrence and increased sensitivity to narrative and sentiment. When confidence flows from collective interpretation rather than centralized influence, markets become faster, sharper, and less forgiving. Another defining feature of the new phase was the recalibration of risk appetite. Institutions adjusted exposure thresholds, favoring flexibility over commitment. Shorter time horizons, dynamic hedging, and increased optionality replaced static positioning. This reflects a deeper acknowledgement that uncertainty is no longer episodic, but structural. The hook embedded here is critical. When uncertainty becomes permanent, strategy must evolve or fail. Liquidity behavior further reinforced the transition. Instead of consistently dampening volatility, liquidity now amplified movement as participants reacted simultaneously to emerging signals. This reflexivity created conditions where price moves fed on themselves, accelerating shifts in sentiment. Such environments reward speed and awareness rather than scale alone. The beginning of this new phase also redefined influence. Authority no longer stemmed solely from balance sheet size or historical precedent, but from responsiveness and credibility. Participants who adapted quickly gained relevance. While those relying on legacy assumptions lost traction, the market began operating as a dynamic network rather than a hierarchy. At its core, the phase that emerged after $92 is one where control is conditional, reactions are immediate, and adaptability determines survival. The signals were subtle, but their implications are profound. Once a market enters this state, it does not revert easily because participants adjust behavior, expectations, and risk frameworks to fit a reality that has already moved forward. The war is over, but the story is not. What comes next will define the future of finance, trust, and power. Remember this moment. Remember this number, because when the banks surrendered at $92, they didn't just end a battle, they revealed a truth. And once the truth is out, there's no going back.